Welcome back to the Raw Selection Private Equity Podcast. Joining us today is Cyril Aboujaoude, co-founder of TioPo Capital, a private equity firm based out of London. We're going to dive into deal origination through to value creation and the journey of a young private equity founder growing his firm from his first deal to where they are now. Let's dive in. Cyril, if you could give us a brief insight into you, please.
Thanks for having me, Alex. So I'm one of three co-founders of TioPo Capital. We back small and medium companies in the UK and France. Alongside my two co-founders, Greg and Shahan, we're very hands-on operational entrepreneurs. Despite our young age, we are extremely focused on operations of businesses and helping them create real value where it matters. In the past 5 years, we've acquired 7 companies, raised our initial fund of 80 million, which we are still in the process of finalizing in terms of final investors. And most of our portfolio has grown quite significantly since inception.
Excellent. So beyond the standard kind of criteria for a company to look to invest, what are the specific things that you obsess over when you're looking at your potential investments?
So typically, in terms of size, we focus on 2 to 10 million EBITDA businesses with margins usually above 15%. But what we really focus on is the actual know-how of the company. What market position do they have, if it is defensible enough? And of course, the added value that they can bring in terms of growth.
Perfect. And beyond the standard kind of financial growth metrics, what are the kind of less obvious signals that you look for?
So we were talking about it earlier, and the main signals is the people, and specifically around the people is if we are acquiring a company that has management that is staying on board, is really alignment on the vision and a proof of capability of execution on this vision, because it's not only having the plan, it's mostly executing on the plan itself. So this for us is what we tend to spend a lot of time on during due diligence. So soft factors like humility, openness, and curiosity are very important for us. But really is having that vision. And some of the times in succession plays, when management teams are not staying, this is where we struggle. And so it's the search of the right person to be able to join us on the adventure, because every single deal for us is an adventure.
I like that. I like that a lot. So do you guys, and I think when it comes down to people, it's very difficult to make assessments of who's going to be good and who's going to be bad. Anybody can put on a facade, anybody can put in, and there's always a level of, there's an element of mistake. And this is coming from a guy who runs a search firm who will tell you that recruitment is a science, not an art. There is an element of art to it. It's just about reducing it. Is there anything that you guys do during that due diligence phase when you're looking at the people? Do you have a scorecard assessment? Do you have a particular questions that you ask? Do you have something that you guys always do that's like, helps us on that journey of trying to get things right more than we get wrong?
Look, Alex, we definitely have our framework. We definitely have, the typical list of questions and boxes to tick on candidates. But at the end of the day, it really comes into, are you executing or not? Because anyone, like you said, anyone can sell anything.
Yeah, of course.
So it's really the first few months on the job that really make the difference or not. So we keep a very open approach, even after selecting the candidate, and then assess very early on whether the candidate is a good fit or not. You go through filtering by having multiple interviews. Reference checks are very important prior to agreeing on hiring someone, but the retest is post hiring. So we're not worried of changing someone that's not delivering quickly. And let me just add that not changing someone fast enough is the biggest risk compared to hiring the wrong person.
You are speaking my language here, Cyril. I think what's interesting and something that I'm harping on about on LinkedIn specifically at the moment is around backdoor references or soft references, and it's getting it from people that actually I've done a lot of this recently and protected people from the firm. It does make hiring harder, but it just means that yes, you might have more pain with somebody not in the seat for an extra period of time, but it stops you bringing someone in and swapping them out. And it's we do that for our searches and processes that we run, and we certainly do it without fail for our own firm as well. We do not let off on that front.
Yeah.
So, looking at the kind of value creation work and work with the portfolio, what's the kind of intervention you've seen that's created the biggest step change in value for your portfolio company?
It's more of of a set of tools of interventions, not one specific, one size fits all intervention. Just to put things into perspective, we realized that operation was the cornerstone of our strategy and the most important value lever. That instead of hiring a fundraising team, we ended up hiring an operating partner that was whose only job is full time focusing on operations of businesses.
Mhm.
So it's really bringing that set of different tools, whether it's on the business development angle, whether it's on the process process. Sorry, let me just repeat that.
That's okay.
Um, whether it's to help on business development, whether it's setting up metrics, setting up new teams, hiring the right people, have technology integration. We help on all of those, and we typically act as the special project hands on deck team with our management teams.
Perfect. So, the kind of you guys build that framework, you have that. Is that the kind of first 60, 90 days process, or is that kind of going out longer tail on that front?
So due diligence takes around 3 to 6 months, depending on negotiations as well. So it's more of a minus 90 days and then the plus 100 days post acquisition. The time zero is just another point in time, which is acquisition time. So a lot of the strategy work, or at least weakness identification, is done during due D, with, of course, finding the right people to come with us on the adventure, whether it's as executives, as board members, or senior advisors to the company. Post acquisition, we go with our typical 100-day value creation plan or business
Okay.
transformation plan, but then we iterate it on a monthly basis, actually.
What's the, looking at businesses, as you mentioned, in that kind of EBITDA range, 5 to 10, what's the one thing that you would like for them to have fixed before your investment, which is just a common up and coming, which is like, guys, hey, if you do this, it'll just make life a lot easier for us. It'll make life a lot easier to scale the business. Might even make it more valuable when you guys have to actually acquire it. But what's that kind of one thing that always crops up? They're like, God, if we could just fix this before they came in, what would that be?
I guess that's the usual suspect, which would be probably ERP integration.
Okay.
It's something that's most of the time overlooked, and that takes a huge amount of time to implement.
Mhm.
Like one of the companies we acquired pre-acquisition, they had started the process of integrating it 2 years before. We're still doing it now. So, so these, if you don't have a real champion within the business, it takes a lot of time and bandwidth. But that's also part of what we offer to our portfolio companies, providing that extra bandwidth to follow on a project from start to complete execution.
Yeah, that's a common problem we see for everybody. CFO coming in, ERP implementation, changing from the old QuickBooks type model.
Yeah.
So quite poignant at the moment. It's not talked about openly, but private equity is not as buoyant as it has been. You know, public markets are seeing records, but kind of from a the world kind of perspective, we're not seeing as much deal M&A origination, execution, even from selling from a private equity perspective. So just looking at how you guys are deciding on the kind of business of that initial kind of review phase, post deal origination and assessment. How are you deciding whether a business will withstand a downturn, or if it just looks good in a current bull market for them or a prior bull market, and you're buying at the top?
That's a great question, and the classic fear of most investors, in my opinion. There are a few ways to to look at it. First of all, really traditional fixed versus variable cost assessment of the business, but try and understand the business as much as possible to really identify what is a real fixed cost and what is a real
Mm.
variable cost, because sometimes your variable costs are more fixed than you think pre-acquisition.
Yep.
Um, Another one is the visibility and the strength of the order book, if you're lucky to have a company with an order book,
Hmm.
and then the cyclicality of your underlying market. And we typically like, if it's old businesses, we typically like to go way back in time, maybe 20 years, if the company has been trading for 20 years, and analyze the 20-year performance of the business to see specifically the 2000, the dot-com bubble
Yeah.
burst, which is not only tech related in terms of underperformance, and the 2008 crisis. COVID is really a one-off for a lot of companies, but you also have the COVID,
Definitely.
you you also have the COVID boom that um, that really affected a lot of businesses. Some businesses really benefited during COVID. Some business didn't at all, but benefited in the 3 years, and we are still in that period. So we also got to be careful about that and looking at the trading performance of the business over time. If it's a business that was not growing significantly, is usually a good indicator of where the real market is for a company like this one, to make sure that you're not buying an overinflated or something that's really bad.
Past performance is not a guarantee of future success, but is the only indicator that gives you a level of guarantee of what future success may be. It's just that old adage of we've done really well in the past, but it doesn't mean we'll do well in the future. But there's not much else you can measure on the basis of that, and it becomes a difficult one.
Exactly, exactly. And it's the it's the actual the real data points that you have on the business itself. And that cannot lie. The business owners can say anything they want on why it's the business is trading at 2x revenue of any historical revenue they've ever done. But the reality is that a lot of out of control um, elements are in play in today's world, with COVID, with geopolitics, with wars. So most often than not, the exceptional trading that we're seeing here is not because the business, if it's not something that's clearly identified in the business plan, or at least in terms of gaining revenue, then it's probably because of macro.
Absolutely. So, what's the most creative deal structure you've used to get something over the line?
I'm gonna sound like a broken disc, but again, that revolves around people, and I'm gonna go back to the first transaction we did in July 2021
Mhm.
with TioPo. So we got introduced to this small leather goods company, fantastic know-how, fantastic manufacturing capabilities, blue chip customer base, an entrepreneur that had acquired it and did a real success story out of it, that we met. And keep in mind, I was 25, my co-founders were 26 and 30. So we were kids. Going and trying to convince the entrepreneur that was selling his life's work to us was hard enough. So the smart way that Greg, my partner, approached it was, we need we need a CEO in the business because you're exiting, you want to retire. Your son is of the right age. He was 30 at the time. He knows the business. He knows finance, so we speak the same language, and he's interested. So what we did, which was not in the picture at all at the time the deal was presented to us, is partner up with the son, Thibaut, to become CEO and shareholder of the business. So Thibaut actually invested with TioPo to acquire the business and manage it. And it's one of our most successful deals. And this really crafted the DNA of TioPo in terms of always partner with the right entrepreneurs and with people with whom we have the shared vision.
How, just taking that back to that first deal, it's like the first anything when you set up a firm, young guys in comparison with the what we traditionally see from a private equity perspective. How hard was it just to get that first deal?
In hindsight, it was hard because if we went through the challenges that we went through at the time, we would be disgusted today. But at the time, we didn't see it as that hard. We're entrepreneurs at heart, and any challenge that we had, it was the first one. It was the first one with who we ever got a. No, that we had a few LOIs accepted
Yeah.
in the past that we dropped because of DD, but it was the first deal that was actually going through. So we were, in true honesty, we were also discovering the job. So there's a bit of that naivety at that time that allowed us to keep going and just pass on challenge after challenge. So so in hindsight, it was. At the time, it felt like the right thing to do.
Yeah, like, I mean, it's anything when you first start, it's difficult, but I suppose you're prepared to put more work in because you kind of don't know what it takes to get where it is. But certainly, as it continues to grow and continues to develop, you kind of realize that there's a law of averages, there's a cadence, there's a certain amount of X will get to Y, and you begin to see, that your skills and your acumen obviously improving. Those numbers begin to come down, and it becomes less painful.
Exactly.
So, what do you read? What do you watch? What do you listen to? Do you recommend others should check out?
Raw Selection is a really good podcast. I like the FT because it UK based. Most of the time, we have has a global view as well. You obviously look at the Wall Street Journal to have a bit of the US angle of things. Usually, it's a lead indicator of what's going to happen the rest of the world. Um, and then try to listen to as many podcasts and as possible. But in our particular case, we focus mostly on local journals or local gazettes to understand what's happening in our regions regarding small businesses, and whether it's in France or the UK. So any publication that we have in these regions, we are very interested, and that can show bankruptcies of companies or companies expanding. And usually, they're a good indicator of what to do or what not to do.
Makes sense. If somebody wishes to reach out to you, say or post this podcast, how best do they get in touch with you, please?
Our LinkedIn on TioPo Capital, my personal LinkedIn, or our website, tiopocapital.com.
Perfect. Well, thank you very much for coming onto the podcast and sharing everything you have done from deal origination to assessment to value creation and the journey that you've had with TioPo Capital. So thank you very much for coming on the podcast.
Amazing. Thanks for having me, Alex. Great chat.
And as always, thank you very much for everybody for yet again tuning into the Private Equity Podcast. If you haven't done so already, please do subscribe. But till the next time, keep smashing it. And thank you very much for listening.